Morning, Market Chameleons and Dimitri Pargamonic. How you doing, buddy?
Good morning, Will. How are you?
Cold. It is freezing here
Yeah,
in
it's so
Pennsylvania
cold.
right now. It is
So
so
cold.
cold. Whoa, whoa, whoa. What's going on
Uh,
here? How you doing, buddy?
yeah. Good morning, Will. You got a echo there.
Freezing here in
Yeah, it's so
Pennsylvania
cold.
right now. It is
So cold.
cold. Whoa, whoa, whoa. What's going on here?
Yeah. You got a echo there.
Yeah, I'm trying to figure that out.
I think you're playing a YouTube live
Yeah.
at the same time.
Yeah, which is usually self-muted. Sorry about that, brother. All right,
Yep.
should be good now. I muted it. All right,
Okay.
good to go. All right, let's get right into the disclaimer. Let me share my
Yep.
screen.
Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer, everyone.
D, as of this morning, I do need professional help, I must say.
I know you like it when I say that.
No, I mean, the amount of the media blitz. I tried to post some things on Discord this morning. There were so many discussions around Reddit, Robinhood. They had the founder of Tasty Trade on. There's so much going on in the marketplace right now. I may need to come down to Philly and get on your couch today.
Yeah, exactly. Well, it's the story behind it, right? Where it's the retail investors and how they feel that they're being disadvantaged by the tools and mechanisms in the that are in Wall Street, and they feel like they're fighting back, and maybe a lot of clarity will be, or it opens up a discussion about like what kind of who the players are and what they're doing, because I did see that Citadel, I think, was one of the hedge funds involved there, and that's a big deal because Citadel actually is a big player on Wall Street because they control the pipes. So when you see retail brokerage firms, they accept orders from retail accounts, but they actually sell those orders to hedge funds like Citadel, or it doesn't have to be a hedge fund, but there are only a few.
Yeah, there's Susquehanna, there's Virtu Financial. I mean, there are a few.
And they actually control those orders. So the people who end up being on the other side of your trade a lot of times are controlling the orders, because they're buying them from these brokerage firms. So their involvement in there, it's almost like this Robinhood is the customer is the person who's paying them for that order flow, and it could have been, I don't know if it is, I'm just saying that's the real customer because that's where their revenue's coming from.
Yeah, they're selling it to the highest bidder, whoever's willing to pay the most for the order.
There's a conflict of interest, because the true customer is the person taking the other side of the bet of your customer and paying you for that privilege, and that's payment for order flow. It exists. It's legal. The SEC said it's legal, and it'll be interesting because if they take these lawsuits, if they take it all the way to court and start peeling back the onion, they're going to start discovering like, well, what's going on here, because you're on both sides of the transaction.
Yeah, it's really, and actually no one's brought that up. You're the first commentator to bring that up on this show. It's the payment for order flow, because what they have said is that they're probably Wall Street firms, aka Citadel, Susquehanna, Virtu, who may have made the most money in this situation, right? With the volatility, the payment for order flow, being able to get in front of customer. I mean, all these things that transpire inside this processing of orders.
Right.
Really interesting.
The worst part is that there's going to be a lot of pain in this because that volatility is going to take a lot of people out, right? They're probably just trying to say, like, hold up, people are going to get hurt here. How do you slow it down? How do you get it back to reality? because like what's going on here, we've never seen this before. It's like people getting together and colluding to create a Ponzi, scheme almost with a stock. So it'll be interesting to see how it ends up. But I could see like, both sides of the frustration, and you've got like brokerage firms who are stuck in the middle, because it's kind of like, who's the customer? Is it the person paying you, or is it the person with the account, opening the account? It's kind of like with Facebook, right? They ask, well, who's the actual customers? The person with the account, you're not really the customer because you're not paying to use Facebook. You're just using it for free. So are you the product, right? And is the customer the advertiser?
Yeah, you're so right.
It's an interesting conversation,
I forgot to mention with the technical difficulties early in the morning, Chris Marcus, aka Mr. Silver, is coming on Monday's show because there's a lot of stuff talk around silver right now. I'm sure he has some interesting comments, so I just thought I'd announce that. And a couple people were talking about silver in the chat. So, anyways,
and you know what I will do is, let me do this. I went to the unusual option volume since you mentioned it, and we talked about this silver. So this is yesterday's unusual option volume, and we see here's a silver miner, First Majestic. They mine silvers, and I saw another one here. There are a couple of them. Here's another one, FSM, that they're starting to see some interest, and we were talking about it because we're like, well, if we do continue to get these stimulus plans, and they keep printing money, and we're slow opening up our economy, inflation is going to kick in. And America we had hyperinflation in America. We had interest rates they took them up to 18%, I think, at one time. So it's not unprecedented to have hyperinflation. And when we're talking about it, we're like, well, maybe something like silver or input prices. And Chris Marcus, I think he's been talking to us about it. He's going to come on Monday. I think the interesting questions to ask him is, when you think about silver, the first thing that comes to mind is like jewelry, right? Like making bracelets or something.
Well, I think there's a lot in the technology too. Silver's.
Yeah. So I just took it. Yeah. And I just brought it up really quick. I just looked it up this morning before the show because we were talking about it yesterday. I see these silver miners, people are coming. You could see like they have big percentage gains here, a lot of option volume, but I just brought it up here. I don't know this website, but it's one of the websites that follows these metals, and you could just see here, according to this website, that silver is used in batteries, dentistry, glass coatings, LED chips, medicine, nuclear reactors, photography, solar energy. We're talking about solar energy. If that takes, it's an input.
Well, you mentioned the two biggest parts of solar energy, right? The actual product that goes on the roof, but the battery in the house, right? Both those things are a big deal.
Exactly. They're in display. You have, they use these semiconductors, touch screens, water purification. So they're used in a lot of places. Silver is used in a lot of places, and if inflation kicks in, or even if the economy picks up, you could see something like so. And we'll ask Chris Marcus, what he thinks and what he sees, but it is used in lots of places as an input price in manufacturing. The other thing we could ask Chris Marcus, that I know that these stocks are really starting to fly right now. Their valuations, according to historicals, are starting to look pretty high, but he'll explain to us that the miners are kind of like a leveraged bet, right, on silver. So as silver is climbing, because they operate on fixed costs. So as silver keeps climbing and climbing, their gross margins are just starting to increase, right? Almost like is that correct? Well,
that would definitely be correct.
All right. So we'll ask him how that works. And if he even has like a example or formula to show us like the relationship between gross margins and and as prices are increasing. Let's take a look. I'll take a look really quickly at the pre-market. Just thought that was worth mentioning. Take a look at the pre-market report, and there is a new feature we pushed out yesterday. I forgot to mention, so I'm going to talk about it today. But these are stocks moving in a pre-market hours. Again, here's that GME that's been in the news, up 81% right now. And what was the new? There was some news on it yesterday, right? They started letting people buy it again.
Well, yeah, and that is the news.
That's why it's up so much.
Yes.
Yeah. Very low float, 1.5 million trading hands in the pre-market hours. But let's go to the higher market cap stocks. See what's going on there. And we see 23 made the percentage gainers list, 44 on the percentage decliners list. Up top, mRNA up 21%, 4.6 million shares.
I think that was based on J&J's vaccine results were not as, positive as people thought they would be. It was a bigger grouping of people in the test with the J&J, and they were live in Brazil and South Africa, where multiple strains were. So their results just weren't as strong. And I think that may be the reason.
So that was like bad news. So I see J&J here down 4%. Yeah. So I guess bad news for J&J, good news for...
Certainly in the short term, there were comments from, I don't know if anyone knows Dr. Gottlieb, but he was within the previous president's group on the early coronavirus task force. He's on, I think, the Pfizer board. He said the J&J results were great, given the size of the group and where they were actually doing... half of the people taking the vaccine were in these real hot zones with multiple different variants. And, I think 85% of the people never got severely sick at all, never entered which is pretty good. And they were giving it to the most susceptible, right? They were all older people getting the vaccine, I think. So
anyway, so you're saying like the J&J, it's not as bad as...
Yeah, it's not as bad as... Moderna, they were, the two previous vaccines, they were saying, the
efficacy.
The rate was above 90%, right? And J&J's was like 72%. So when you look at those two numbers, you're like, wow, why would anyone take it, right? But given the scope of the trial and where it was taking place and the people it was a much bigger trial. And so this guy who's on, again, the Pfizer board, who has a competing vaccine, was like, these results are really good. So anyways,
and I do see, like, besides mRNA, I see other biotech stocks in here on this list right now. So BIIB, Eli Lilly, Pfizer is on there. So I don't know how it's all related to them, but they're seeing some pretty decent pre-market moves in those stocks.
I'm just interested. It's interesting to see that as many people want to take the vaccine as do. That the lines are long. I was worried from, talking to people that a lot of people weren't going to take the vaccine. So it seems like a lot of people do want to take it, which is interesting too.
I think it's just when you're sitting at home and you're scared of getting sick, or not being able to go out, at some point you're just like, you surrender. You're like, just give me the vaccine because I want to go live my life. Because how long can you just stay at home? If you're at some point you're like, just give it to me. But yeah, if it's effective and everybody takes it, it seems like that should be like the path to get out of this mess. Let's move on because we're already like halfway through the show. I'm going to start showing a few new features that we did publish yesterday. Unless you have questions, Will.
Nope, you're good.
All right. So we talked about, we're going to start working on fundamentals. And we released the very first tool. I'm still working on it. But what this tool is, I'm going to go to SPY under fundamentals. So these are ratios. And the idea behind here is, well, if you're going to start using your, fundamental analysis, you need some kind of benchmarks, right? You're trying to beat some kind of benchmarks. And we looked at it as here ETFs, We have lots of different ETFs, and let's treat an ETF as, what if you just bought all the stocks in, right? It's like you own all the stocks. So it's like one company, right, that's diversified based on the holdings in that ETF. So let's take a look what we mean. So here's SPY, and here are the ratios. I'll start going through them. So this is the PE of SPY, 37.28. And what this is saying is, if we took the stocks in the S&P 500 SPY, took their market cap, summed up the market cap of the holdings, and we divided up by the sum of all the earnings of the holdings, right? So we took all their earnings, took a total, took all the market cap, took the total market cap divided by total earnings, net earnings. It's 37.28. So that's the PE right now of the SPY holdings. And we could compare that to itself. Historically, we see that 3-year average, it's been 27, 5-year average 26. So we see it's way above there. That's 2.3 standard deviations above its 3-year average, 3.1 above its 5-year average. So we see that the multiples right now are very high. This is how high they are relative to the mean. And of course, we have a few things. We got 0% interest rates right now going on, and we got a bunch of money getting pumped out as far as stimulus goes. Price to sales. So this is market cap divided by just total revenue. So these are net earnings. These are just total revenue before you take out any expenses, cost of goods sold. Here we see right now we're at 2.89 in the SPY. That compares to 2.5 in the 3-year average, 2.37 in the 5-year average. So again, we're 2 standard deviations away from that mean from historicals. This one's interesting, price to cash. So this is how much cash are they holding relative to the market cap. So if we took market cap versus the cash on the books, 9.34, that compares to 3-year average 10.87. So that's below, so meaning they've got more cash on the books relative to their market cap than before, and 10.37 on a 5-year average. Price to book, we see same thing, 13.42. That's above the 3-year historical mean, and it's above the 5-year historical mean, a little bit over 1 standard deviation. This is price to EBIT. So this is the market cap divided by their earnings before they pay interest and taxes. Okay, so earnings before you deduct interest expenses and taxes. So here we're at 27.73. That compares to a 3-year average of 20.52, 5-year average 19.43. So we see 2 standard deviations above, 3 standard deviations above the 5-year. Here, price EBITDA. This is earnings before interest, taxes, and depreciation and amortization, right? So some stocks, they get to depreciate their assets, and that takes away from their earnings. So before they pay interest, before they pay taxes, before they deduct any depreciation, right now, that ratio is 17.88. That compares to a 3-year average of 14.1 and 5-year average 13.43. So we see these valuations also relatively rich compared to that 3-year and 5-year historical mean. Now let's take a look. Well, how are they doing as a group profit-wise? So we see here their gross margins right now. So gross margins are revenue minus the cost of goods sold. So if we take those gross profits divided by revenue, we see gross margins 31.5, which is slightly lower than their 3-year and 5-year average of 32%. Net margins, those decreased by even a wider margin, 7.8%. So net margins is, gross profits minus all the other deductions. What do they have left over on net divided by revenue? 7.8% versus 3-year average 9.4, 5-year average 9.2. Debt to equity, that's a ratio went up a little bit above 1.0, above 1.03 compared to a 3-year average of 0.99, 5-year average 0.97. This is debt to cash. Debt divided by cash on hand, 2.3. That's a little bit lower than the 3-year average and the 5-year average. Then we have this, instead of price to earnings before interest and taxes, we say, well, what is the ratio of their debt relative to how much they earn before they pay interest, taxes, and depreciation? Well, that's right now 3.48 compared to 3-year average 2.83, 5-year average 2.77. So above there. And these are here really quickly, the earnings yield, EBIT yield, and EBITDA yield. So what this is saying is that just like you have a dividend yield, what is their earnings yield? So if, whatever, after they pay all their expenses, this is how much net earnings is left over. We divide it by those total earnings divided by the market cap, right? So if you bought all the stocks, right? So imagine you bought all the stocks and then you took all the earnings after interest and taxes and everything, what would you yield per year? That's 2.7% versus 3.8%, 3-year average, and 5-year average 3.9. So really, it's not a huge yield, but when people do comparisons, it's above the risk-free rate. At least we're above the risk-free rate, but not a huge, yield there. Earnings, EBIT yield, earnings before interest and taxes, 3.6. You could see that's lower than the 3-year average. 5-year average, EBITDA yield, 5.6, lower than the 3-year average, 5-year average here, 5.6%. So we took it a little bit at the fundamentals, but besides the valuations, right? Okay, are these, right now they're rich. Is it justified? Because sometimes you give it a higher valuation, could be justified. But here we'll see like how is it growing. So at least we have the revenue growth here. So here's their revenue, total revenue in S&P 500 right now. Last year it was down, mostly probably because a lot of companies didn't do too well during the shutdown. 3-year average. So this is an annual average over the last 3 years, 4.8%. 5-year average growth, 4.6. Net income, that was way down last year. 3-year average, that pulled down the entire 3-year average, and you can see here 5-year average 1.9%. Gross profits down last year. 3-year average 4.3%. 5-year average 4.2. We see total debt increased, 7.3% in last year. That's comparable to the 3-year average, 5-year average. Total assets though increased as well. 8.1% last year. 3-year average 6.5%. 5-year average 5.7. So total equity, that's what's left to the shareholders, right? So you have total debt, total assets. So if you're taking your assets and you say, okay, well, if I subtract all the debt, what would be left over? If I sold everything, paid off my debt, what's left over to the equity holders? That increased by 2.2%, 1 year, 3-year average 4.9%, 5-year average 4.8%. And we see cash really increased, the cash on hand 40. And that could be, just to me, looking really quickly, that could be just they're increasing their debt and putting it in cash. That's what it kind of looks to me. So, if you issue bonds and you preferred stock or whatever it is, you have debt, but you're taking that cash on hand. And it could be a good sign, like maybe they're either getting ready to make investments or maybe they're looking to buy other companies, right? So this could be an indication that there might be some cash on the books ready to make acquisitions. So that's really quickly how to read these tables. And I'm going to go below here. And this is a breakdown of the S&P 500. So you could see Apple, Microsoft, Google, they're up on the top of the list. You got market cap, total revenue, cost of revenue, gross profits, net income, cash and equivalents, tangible book value, EBIT, we talked about, EBITDA, shares outstanding. So I'm going to make, just to show you guys really quickly, I'm going to make these as a percentage of total revenue. So here's the market cap. You know, if we took the market cap of all the stocks in there, Apple represents 7% of all of it. You know, Microsoft 4.8%, Amazon 4.7%, Google. And why this is important is this is a cap weighted index. So you have 500 stocks in there, but they're not all weighted the same. Here, let me show you what I mean. I'm going to just open up a really quickly. So Apple gets more weight in that index than, you know, a stock, you know, that's like here, ACN. Let me show you really quickly. I'm going to go to SP. I'm just going to open up a new window to leave that one up. But here in the ETF, I'm going to go to the holdings. Right. So here's Apple's weighting in this SPY. 6.85% of SPY is Apple. 5.65%, that's Microsoft. So I'm just going to go down. These are the, you know, the first page shows the top 25. So here, Abbott on the top 25 is the last one, 0.67 versus Apple 6.85. So Apple has 10 times as much weighting as Abbott. Okay. So that's what we talk about cap weighted, that these indexes and ETFs, when they're cap weighted, they're not getting the same weighting. There's more of this inside it than this. But let's take a look at total revenue, and I'm gonna just sort these. Okay, so if we took the total revenue of stocks in this SPY, Walmart is 4.5% of the represents 4.5% of those total revenue. You know, then you got Amazon, Berkshire Hathaway, Apple right here. Number 4, CVS. Let's take a look at net income. So this is just in revenue. What about net income? That's total earnings. So total earnings, Apple is 6%, Microsoft 5%, Berkshire Hathaway 3.8%, Google 3.8%, JP Morgan then goes to 2.7%, Facebook 2.7%. So you could see here how much of the net total net income is at the top. All right, what do I have? Almost 20%, you know, going down to here. So there's a huge concentration of the earnings way at the top. Look at the gross profit. Let's do it by gross profits. So gross profits, Walmart 3.5%, Apple 2.7%, Microsoft, AT&T, Google. So you could see where the concentration of the earnings are in the SPY, and that's why you get so much weighting. Again, if you're looking to beat these benchmarks, right, you have your SPY benchmark, and you have these other stocks. You could always create your own basket, right? Because what are people who seek alpha, right? Seeking alpha. If you could extract the best companies and hedge it by the SPY, right? You have a basket of what you think will be the outperformers or the undervalued or whatever. You're hedging the market with SPY. You know, you have what you call would be like a pairs trade. So just showing you different ways to analyze this. Let's see who has the most, you know, cash and cash equivalents. I think banks, just because the banks will be up top. That's just because that's their model. But let's go.
And they're forced to, right? I mean, that's
they're forced to, right? So let's go below the financials. So I see GE right now represents 1% of total cash in the S&P. Apple, you know, has a lot of cash on hand. Amazon, you know, below that, Oracle. So you could see here where in as far as the cash on hand in the SPY holdings, who's on a relative basis has a lot of cash on the books. We're running up against the bell wheel, so I just kind of wanted to introduce that in the beginning. You know, we don't have the financials for every ETF right now, especially ones with foreign stocks that we can't get a handle of what their financials are. But like I think a lot of the major ones, QQQ, SP, you know, we did roll these out.
Yeah, and like all new features, you may find bugs. So please, if you see anything, take a screenshot, email support@MarketChameleon.com. Dima, awesome job, always bringing it. I guess I won't see you this weekend, but Monday we'll have our Monday show. And then Monday night, we're on with Chris Marcus, aka Mr. Silver.
Yep. Well, thanks everyone for joining. Stay safe. Have a great trading day. Have a